We have officially entered the event horizon. For months, we warned that the silver market was trading on borrowed time. We warned that the paper price in New York was a fiction, a digital illusion maintained by algorithms that were becoming increasingly disconnected from physical reality. We warned that when the dam finally broke, the water wouldn't flow calmly. It would crash. Today, Monday, January 12th, 2026, that dam didn't crack. It disintegrated. Look at the chart. Don't just glance at it, study it. Silver on the COMEX surged to an all-time high of 84 during the early session and is now battling around 82.79. That's nearly a 4% move in a single trading day. On its own, that's historic. But if you're only watching the New York price, you are missing the most important data point of the day, the number that explains why the banks have lost control. While Wall Street is staring at $82, searching for resistance, hoping for a double top, looking for any excuse to sell, the Shanghai Gold Exchange quietly fixed the price of silver at $91.13. Let that number sink in. $91.13. There is now a $7 spread between the Western paper price and the Eastern physical price. This is not an arbitrage opportunity. This is a structural fracture. This is the physical market in Asia screaming that the paper market in New York is insolvent. When spreads reach this magnitude, you are not witnessing volatility. You are witnessing the death of a pricing mechanism. The COMEX is telling you silver is worth $82. Physical buyers in Shanghai are paying $91. One of these markets is lying. And history tells us exactly which one. The market with leverage always loses to the market with delivery. Physics always wins. The price in New York has only one possible direction, up. It must move higher to meet Shanghai. If it doesn't, traders around the world will buy paper silver in New York and sell physical silver in Asia until Western vaults are completely drained. This is how squeezes happen. This is how systems break. Now let's dissect what happened this morning. Silver opened the session at 80.69 hours. It dipped briefly to 79.95, and then the vacuum opened. The price didn't climb, it teleported. In a near vertical move, silver ripped straight to $84. If this pattern feels familiar, it should. We saw it in March of 2022 in the nickel market, when a massive commercial short was caught on the wrong side of a geopolitical shift. Prices went vertical. The exchange broke. Trades were canceled. Confidence evaporated overnight. What you're seeing in silver today is the early stage of that same pattern. That vertical green line on the chart is not bullish enthusiasm. It's a crime scene. It's the footprint of a forced buyer. Somewhere deep in the plumbing of the financial system, a massive entity, likely a bullion bank or a major industrial hedging fund, ran out of collateral. They were short silver at $75. When the Shanghai price hit $91, their risk models exploded. The clearinghouse computers took over, and when machines are forced to buy, they don't negotiate. They bought at $81. They bought at $82. They bought at $83. They didn't stop until they hit $84. But we need to remain rational in the face of this volatility. If you look closely at today's candle, you'll notice a wick at the top. The price hit $84 and was pushed back down to the low $82 range. The mainstream media will call this a rejection. They'll say the rally is over. They'll tell you smart money is taking profits. That is a lie. That wick is not profit-taking. That wick is desperation. It represents the final stand of the remaining short sellers. They are defending the $85 level with everything they have, because they know exactly what happens if silver closes above 85 while Shanghai remains above 90. They become insolvent. So they are dumping paper contracts they do not own. They are selling futures that cannot be delivered. They are trying to paint the chart red to scare you out of your position. And yet, despite maximum effort, despite massive selling pressure, the candle is still green. The trend is still up. The lows are still rising. This confirms something critical. The suppression algorithm is broken. Back in December, when the banks smashed the price, silver stayed down for a week. Today, they smash it, and it bounces back within an hour. The law of diminishing returns has reached the manipulation desk. Now we need to talk about the Monday morning gap. Gapping up through an all-time high on a Monday is a very specific technical signal. It means pressure built while the markets were closed. It means news, Shanghai pricing, and industrial shortages accumulated over the weekend. And the moment the bell rang, that pressure exploded into the market. This creates a psychological crisis for anyone sitting in cash. If you were waiting for a pullback to $75, you're now realizing that pullback may never come. You're staring at $83 and feeling the fear of missing out. That fear is not emotional, it's structural. It's what drives the next leg of the rally. Funds that are underweight silver cannot afford to underperform their benchmarks. They are forced to chase the price higher, regardless of valuation. But here's the warning. In vertical markets, volatility becomes the bank's weapon of choice. They may not be able to stop the price from rising, but they can make the journey painful. It is entirely possible we see a violent flush later this week. They may attempt to drive silver back to $79. If that happens, do not panic. Do not sell physical metal. A drop to $79 would simply be a backtest of the breakout level. It's the market checking whether the floor is solid. That's normal. That's healthy. But given the $7 Shanghai premium, there's a very real possibility that the backtest never comes. We could see limit up days. We could see exchange halts. We could see price controls fail in real time. At this point, you must change your mindset. You're no longer trading a range. You're surviving a currency reset. When you see silver at $84, don't think silver is expensive. Think the dollar is broken. What you're watching is the purchasing power of fiat currency evaporating in real time. The silver chart is simply the inverse chart of dollar credibility. And with Shanghai paying $91, the credibility of the COMEX pricing mechanism is effectively zero. The disconnect between the screen price and the street price is now undeniable. If you call a dealer today to buy silver eagles, they want to sell them to you at $83. They'll quote you $100, or they'll tell you they re out of stock. That is what a physical default looks like. The screen price is for paper, the street price is for metal, and the spread between them is widening by the day. So as we close this first phase of the analysis, the technical verdict is clear. The market has shifted from accumulation to vertical liquidation. The $80 ceiling is broken. $84 has been touched. And $91 is acting like a gravitational magnet. The banks are fighting a losing battle. They are trying to hold a beach ball underwater with a toothpick. They may win a few minutes of price action. They may paint a red candle here and there. But the physics of the market are relentless. And while algorithms in New York were fighting over paper contracts, a very different and far more terrifying conversation was happening elsewhere, in the boardrooms of the world's largest manufacturing conglomerates. To understand why silver isn't crashing back to $60, why $84 is acting like a floor instead of a ceiling, you need to step into the shoes of a procurement officer at Samsung or Tesla. You are not a trader. You do not care about moving averages. You care about one thing: keeping the assembly line running. Samsung has already committed billions to mass-producing solid-state batteries. These batteries rely on silver-carbon nanocomposite anodes. This isn't speculation. This is chemistry. The factories are built. The tooling is installed. The contracts are signed. And when supply becomes uncertain, price becomes irrelevant. That is when panic buying begins. That is when floors are created. That is when paper games end. And that is exactly where we are now. But here's the problem that emerged over the weekend. Every contract that had been signed assumed one thing above all else: available supply. The models assumed that the London vaults had metal. They assumed that COMEX delivery mechanisms still functioned. They assumed that paper promises could still be converted into physical reality. When the price gap opened Sunday night, and when Shanghai fixed silver at $91.13 on Monday morning, those assumptions collapsed instantly. Put yourself in the position of a senior Samsung executive responsible for sourcing silver. You open your terminal and see Shanghai trading at $91. You glance at New York, still printing $82. But unlike a trader, you understand logistics. You understand flows. And you know something most market participants don't fully appreciate. Every unallocated ounce of silver on the planet is now moving east. Metal does not sit still when spreads reach this level. It flows toward the highest bidder. And right now, that bidder is Shanghai. That means silver is leaving the Western Hemisphere. If you hesitate, if you wait for a technical pullback, if you hope the chart looks better tomorrow, you risk something far worse than overpaying. You risk running out of raw material. And if your factory in South Korea or Nevada runs out of silver, the assembly line stops. If the assembly line stops, delivery schedules are missed. If delivery schedules are missed, stock prices collapse. And if your stock price collapses, market share migrates straight into the hands of Chinese competitors who, quite frankly, secured their silver reserves years ago. So what do? You do not wait. You do not negotiate. You panic buy. You pick up the phone and call the mining companies directly: Mexico, Peru, Chile. You tell them to forget COMEX, forget London. You offer $85 an ounce, cash, right now, if they ship concentrate directly to your refinery. This is what's known as ghost supply. This metal never touches a public exchange. It never appears in warehouse reports. It bypasses the visible market entirely. From the outside, it looks like supply is vanishing. In reality, it's being privatized, locked up by industrial giants who are terrified of being cut off. This is where mainstream analysis completely breaks down. Most analysts assume demand falls as prices rise. That's true for discretionary goods. If a luxury handbag doubles in price, consumers buy fewer handbags. But silver is not a luxury. It is a strategic input. Let's do the math. A high-performance solid-state battery contains roughly 50 grams of silver. At $60 an ounce, that's about $100 worth of silver per vehicle. At $84 an ounce, that cost rises to around $135. That was a $35 increase in the materials cost of a $50,000 electric vehicle. Does that stop production? Does that stop consumer demand? Of course not. It's a rounding error. Automakers can absorb it. They can pass it through. What they cannot do is build a car without silver. And that is the critical distinction. Demand does not fall when silver rises to $84. In fact, demand often increases because fear of unavailability outweighs the pain of higher prices. Samsung would rather pay $100 an ounce in secure metal than pay $80 an ounce and shut down a factory. That fear creates something far more powerful than speculation. It creates a price floor. Banks can short futures. They can dump millions of paper ounces onto the market in an attempt to smash price. But they cannot print silver bars. Samsung needs atoms. Tesla needs atoms. Solar manufacturers in Germany need atoms. And those atoms are now going to the highest bidder. At the moment, that bidder is the Shanghai Gold Exchange. This effectively places a put option under the silver price. If silver drops to $78, industrial buyers will step in aggressively, not because it's cheap, but because it's critical. To them, it's a survival input. What we are witnessing is the industrialization of silver's monetary premium. For thousands of years, silver was money. For the last century, it was treated as a mere industrial commodity. Now it is both at the same time. It is a monetary asset being squeezed by industrial necessity. And we haven't even discussed the military dimension yet. Look at the geopolitical headlines of the past 2 weeks. Tensions are rising globally. The U.S. military operation in Venezuela on January 3rd required massive logistical coordination. Modern warfare is electronic warfare. Every missile, drone, satellite, radar system, and communications array requires silver. It is the most conductive metal known. You cannot fight a high-tech war without it. The U.S. Department of Defense does not maintain a strategic silver stockpile. It sold those reserves decades ago. If conflict expands, the Pentagon becomes yet another inelastic buyer. Do you think the U.S. military cares whether silver is $84 or $184? They print the currency. They will pay whatever is required to secure guidance systems, sensors, and communications infrastructure. So now picture the competition. Samsung versus Tesla. Tesla versus the Pentagon versus China. China versus India. India versus central banks. All chasing the same shrinking pile of physical silver. And standing in the middle of this collision are commercial banks on COMEX, holding naked short positions and praying for a price collapse that never comes. They are standing on railroad tracks, trying to stop a freight train with a piece of paper. This brings us to the refinery bottleneck, an often overlooked but absolutely critical detail. Even if silver comes out of the ground, and remember, mine supply has been flat or declining for years, it still must be refined. It must be converted into 999 fine bars suitable for industrial use. Refineries have hard capacity limits. You cannot flip a switch and double output. Refining takes time, energy, and specialized infrastructure. We are hearing increasing reports, currently unconfirmed but consistent with market behavior, that major refineries in Switzerland and Canada are fully booked for the next 6 months. They are running around the clock. There is no slack. This means even at $200 silver, supply cannot surge quickly. The pipeline is clogged. So when silver gaps higher on a Monday morning, the market is pricing in immediacy. Immediate silver is worth more than future silver. This is backwardation. Backwardation is not normal. It is a distress signal. It means spot metal trades above futures because buyers are willing to pay a premium to secure delivery now rather than trust delivery later. Why? Because trust has broken. For 40 years, global supply chains operated on just-in-time efficiency. Inventory was minimized. Storage was considered wasteful. That era ended this weekend. We are entering the era of just-in-case. Companies will hoard. Inventory buffers will expand. Instead of holding 2 weeks of silver, manufacturers may hold 6 months. If every major electronics producer triples inventory buffers, demand doesn't rise 5%. It doubles overnight. That is the demand shock unfolding right now. It is an inventory rebuild occurring simultaneously with a currency credibility crisis. So when you see silver whip between $80 and $84, don't focus on the noise. Look through the chart. Visualize the procurement officer in Seoul staring at an empty supply spreadsheet. Picture the military logistics officer in Washington yelling into a phone. Imagine the refinery manager in Switzerland explaining a 6-month waiting list. That is the reality. The chart is just the shadow cast by that reality. The banks want you to believe this is speculation. They want you to think it's a bubble. They want you to sell so they can cover shorts and ship metal to industry. Do not be their liquidity. The industrial floor is real. The geopolitical floor is real. The monetary floor is real. $84 is not the top. $84 is the panic button. And the panic is only beginning. In the next phase of this deep dive, we turn to the final accelerant, the retail wave. When the public wakes up, shelves empty in hours. Google Trends is already flashing red. Dealer inventories are vanishing. Premiums are exploding. The unobtainium phase is next. And once it starts, there is no rewind button. Industry is buying silver because it has no choice. The public is about to buy because it wants to. And the banks, soon, the banks are going to realize they are standing on the wrong side of history. This is how every great market transition unfolds. Smart money moves first, and it moves in silence. Industrial money moves next, and it moves in desperation. But public money moves in a stampede. In the first two parts of this deep dive, we exposed how the whales, the central banks, and the manufacturing giants quietly cornered the silver market. They didn't announce it. They didn't ring bells. They drained wholesale vaults while prices were suppressed. They bought during consolidation. They bought the dips when no one was watching. But today, the secret is out. A 10% move in 2 trading sessions is not a normal price fluctuation. It's a flare fired into the night sky. It is the moment when the average person, who hasn't looked at silver since 2011, suddenly looks up and sees a rocket ship. This is the beginning of the retail tsunami. This is the psychological shift from, is silver a good investment, to, how do I get silver before it's gone? And the early indicators are already flashing red. We are no longer talking about chart patterns or moving averages. We are talking about human behavior. Over the weekend, global search volume for the phrase, how to buy silver, surged dramatically. Social media narratives flipped overnight. Silver went from being dismissed as a dead rock to being framed as the next Bitcoin. That narrative shift is lethal for the banks. Retail investors are not valuation sensitive. Hedge funds calculate fair value. Retail buyers chase momentum. When a person sees silver move from $80 to $84 in days, the rational part of the brain shuts down and a single thought takes over. I'm missing out. So they log into brokerage accounts. They drive to local coin shops. They bring waves of capital that do not care about resistance levels, trend lines, or pullbacks. But here's the problem. The pipe is too small. The retail silver market, coins, rounds, small bars, is a microscopic slice of the overall silver ecosystem. It is the tip of the iceberg. The vast majority of silver exists in 1,000-ounce industrial bars. And when Samsung, Tesla, and solar manufacturers vacuum those bars out of circulation, there is nothing left for private mints to convert into retail products. The feedstock evaporates. And that's exactly what we're seeing now. Dealer inventories are breaking down in real time. Major online bullion dealers are flashing warnings, delayed shipping, high-volume alerts, and the most ominous phrase in retail metals, call for pricing. Why do dealers say that? Because volatility has become so extreme that automated pricing systems can't keep up. If a dealer sells you silver at $85 and the price gaps to $90 minutes later, they take a loss. So they do the only rational thing. They turn off the buy button. Sales freeze. This is how a market enters the unobtainium phase. And the screen might say $82.79, but try to buy an ounce of silver at that price. You can't. Dealers are charging premiums of $15, $20, even $25 over spot. That means the real street-level price, the price to hold metal in your hand, has already crossed $100. The disconnect is now complete. We no longer have one silver market. We have 2. There's the paper market on COMEX, where banks trade digital contracts to set a synthetic price. And then there is the physical market on the street, where real metal trades at massive premiums because there simply isn't enough to go around. This divergence leads directly into the most dangerous trap for new retail investors, the ETF illusion. When excitement hits silver, most retail participants do not buy physical metal. It feels inconvenient. There's shipping, storage, insurance. So they open a stock trading app and buy a silver ETF, believing they're participating in the squeeze. They are not. Buying a paper ETF during a physical shortage is like buying a ticket to a concert that already burned down. You own the ticket, but there's no show. The authorized participants behind these ETFs are often the same bullion banks holding short positions. When retail money floods into ETFs, it doesn't squeeze supply. It provides liquidity to the very institutions suppressing the price. The metal is leased, rehypothecated, and shuffled through opaque mechanisms designed to delay delivery. This is why the old rule has never mattered more than it does right now. If you can't hold it, you don't own it. Central banks understand this. That's why they buy physical gold, not ETFs. Chinese industrial buyers understand this. That's why they take delivery in Shanghai. Retail investors who fail to learn this lesson will eventually be left holding a broken promise. So what happens next? As awareness spreads, panic accelerates, coin shops see lines. Delivery delays stretch from weeks to months. Premiums expand until the paper price becomes irrelevant. And this places COMEX in an impossible position. If the street price is $110 and the COMEX price is $82, any trader with a warehouse receipt will stand for delivery. They will remove metal from COMEX at $82 and sell it on the street for $110. That arbitrage drains the exchange. This is how exchanges fail, not with a bang, but with empty vaults. And those vaults are already bleeding. The registered category, the silver actually available for delivery, has been declining for years. It now sits at historic lows. The 10% move we just witnessed is the market sniffing the bottom of the barrel. At $80, there is no metal, so price moves to $90. If there's no metal at $90, it moves to $100, and it keeps moving until someone is willing to sell. But who is selling? Are you? You held through the bear market. You understand the battery demand. You understand the debt crisis. You don't sell insurance because the house caught fire. You hold it tighter. So now we have a market with massive new industrial demand, panic buying from retail, and a legacy holder base that refuses to sell. That is the textbook setup for a vertical melt-up. But the warning must be repeated. Do not use leverage. The banks know retail has arrived. They know emotions are high. They know new buyers are overextended. They will attempt flash crashes, sudden violent drops designed to trigger stop losses and margin calls. If you are trading on margin, you will be wiped out. You may be right about direction, but you'll be forced out before the destination. Physical metal does not care about flash crashes. Your ounce remains an ounce. It still conducts electricity. It still stores value. It still exists outside the banking system. The retail tsunami is the final wave. Smart money came first. Industrial money came second. Public money is arriving now. When the public arrives, volatility explodes. $5 days, $10 days, maybe more. Stability is gone. We are entering the mania phase. And in the final act of this cycle, we must ask the only question that matters. Where does this end? Once an asset breaks all-time highs and enters price discovery, there are no maps, no resistance levels, no historical reference points. So asking whether $84 or $100 is the top misses the point. The dollar itself is the broken variable. Measuring silver in dollars at this stage is like measuring a bridge with a rubber band. The unit of account is failing. The move you're watching is not silver going up. It's currency credibility going down. The end game is not a price target. The end game is a reset. And when that reset comes, the banks will discover they were the only ones left without a chair. The retail tsunami has made landfall. Hold fast. The problem is not that the bridge is getting longer. The problem is that the measuring tool is breaking. When a rubber band stretches, the bridge appears to expand, but nothing actually changed. That is exactly what happens when we measure real assets in a failing currency. So instead of asking how high silver can go in dollars, we must ask a far more important question. How does silver relate to gold? Because gold and silver are not just commodities. They are monetary metals. Look at gold today. It's trading around $4,180 and holding firm. Gold is no longer speculative. It has become the anchor of the emerging financial system. Central banks are not buying tech stocks. They are not buying crypto. They are buying gold, physical gold. Now compare that to silver. Throughout monetary history, from the Roman Empire to the foundations of the U.S. Constitution, the natural gold to silver ratio hovered around 15 to 1. For every ounce of gold pulled from the earth, roughly 15 ounces of silver existed. That ratio defined value for thousands of years. But in the modern financial era, something unnatural happened. The ratio exploded to 80, 90, even 100 to 1. That wasn't a discovery of abundance, it was suppression. Silver was treated as a disposable industrial byproduct instead of a scarce monetary asset. Paper markets buried its price, leverage distorted reality. Today, that distortion is breaking. With gold at $4,580 and silver near $82, the ratio has already collapsed to roughly 55 to 1, and it's still falling. Mean reversion has begun. Now do the math. If silver merely returned to its historic monetary norm of 15 to 1 against today, gold price, silver wouldn't be $82. It would be over $300 per ounce. That means at $82, silver isn't expensive. It's deeply discounted, trading at more than a 70% discount to its historical monetary value. This isn't a bubble. This is a catch-up trade, and everyone who matters knows it. Algorithms know it. Institutional capital knows it. Central banks know it. When gold becomes too expensive, capital always flows into silver, the poor man's gold, because it offers more leverage and more upside. That's why $100 silver isn't a question of if, it's a question of when. In fact, it's already happening. The Shanghai price is hovering in the low 90s. The street price for physical metal is already above 100. The only thing lagging is the paper price, and paper always follows physical eventually. $100 is not just a price level, it's a psychological trigger. Humans are wired to react to round numbers. When silver crosses $100, it won't be a quiet event. It will dominate headlines, it will flood mainstream media, it will feel like overnight success, but it won't be. That moment will represent maximum danger and maximum opportunity. Which brings us to the hardest question. When do you sell? Many of you are already thinking about it. You look at your stack. You convert ounces into dollars. You feel rich. You imagine paying off debt, upgrading lifestyles, cashing out. But stop and think carefully. If you sell silver for dollars, what are you really doing? You are trading a hard asset that is appreciating for a soft currency that is collapsing. You are jumping off the lifeboat and swimming back to the Titanic because the Titanic still has lights on. The dollar is not the destination. The dollar is the casualty. We are living through a currency reset. Signals are everywhere. Massive sovereign bond sales, exploding debt, structural cracks that cannot be patched. History is brutally clear on this point. In every currency collapse, from Weimar Germany to Zimbabwe to Venezuela, the people who sold their gold and silver early regretted it. They became paper millionaires just in time to discover that money could no longer buy food. So what is the real exit strategy? You don't sell silver for paper. You exchange silver for productive hard assets. This is the ounces to acres strategy. You trade metal for land, for rental property, for businesses, for energy infrastructure. You wait for the moment when silver is so scarce and mania so intense that real estate collapses relative to metal. Today, it might take thousands of ounces to buy a home. At the peak, it may take hundreds. That is the trade. One form of generational wealth for another, without touching fiat currency at all. But we are not there yet. At $80, silver is just leaving the launch pad. The coming weeks will be violent. Volatility will be extreme. Banks will attempt smashdowns. Rumors will spread. Headlines will lie. Ignore the noise. Watch the flows. Is industrial demand stopping? No. Is Asia backing off? No. Is physical supply increasing? No. The fundamentals are locked in. There is no return to $20 silver. That world is gone. We are entering the age of resource nationalism. Countries with silver will hoard it. Countries without it will fight for it. And you, the individual investor, are standing in the middle of that struggle, holding the very thing everyone needs. Do not let them shake you loose. Secure your position. Educate your family. Prepare for volatility. This repricing is not about getting rich. It's about surviving the transition from a debt-based system to a resource-based reality. The future belongs to those who hold what is real. Welcome to the age of real money.